The most popular category which has now become popular is the multi-asset allocation fund. Why is it popular? Because you look at the requirement, minimum 10% in equity, minimum 10% in debt, and minimum 10% in alternates. You can ignore the conservative hybrid because equity savings is a much better product. Let me explain to you why. If you are somebody who've lately got excited that you want to do gold and silver, these are the funds that you want to focus on, and I'll tell you why. The only disadvantage of probably a multi-asset fund is, hi everyone, in this particular video we are going to demystify everything that you need to learn around hybrid mutual funds in the India mutual fund business. A lot of y'all probably think that hybrid is not for you because you are either an aggressive investor or a conservative investor. But in this video, I'm going to break all of those myths for y'all. If you are a conservative investor or a moderate investor or an aggressive investor, there is actually a hybrid fund for you. If you are an equity investor, there is a hybrid fund. If you are a gold silver investor, there is a hybrid fund. There is actually a hybrid fund for each one of you. It is just that you don't know which is the right hybrid fund for the one that you want to invest. So we will demystify everything that you need to know about hybrid mutual funds, from what are the different types, how are they different from each other, who should invest in which kind of hybrid fund, and which kind of hybrid fund can replace a traditional fund or a product in which you are investing, taxation around it, how should you select the mutual fund, everything in the next 20 minutes. Now there are 7 different types of hybrid mutual funds. First is the arbitrage mutual fund. Second is the conservative. Third is the equity savings. Fourth is balance hybrid. Fifth is balance advantage fund, which is also called as dynamic asset allocation fund. Sixth is the multi-asset allocation fund. And the seventh is the aggressive hybrid. The first thing that you have to understand is that a hybrid fund, like the name suggests, is a combination of a lot of asset classes. It is hybrid. It is not 100% equity or 100% debt. Hybrid, by the name itself, says that it's a combination of either equity, fixed income, or other asset classes which are also called as alternatives. So the first thing, if you want to understand how are these 7 hybrid funds different from each other, you will have to understand which hybrid has how much equity, how much debt, and how much alternates. Once you understand that, you will actually understand how are each of these categories different from each other. So let's first try and understand the differentiation between all the 7 categories. First, when you look at the first category, which is the arbitrage fund. Arbitrage fund, like the name suggests, this is the fund in which when you invest, your entire money is actually invested by the fund managers to do arbitrage. Now, a lot of y'all may probably not know what arbitrage is. Arbitrage in very simple language is, let's say for example, if there is this stock called Reliance Industries, hypothetically, which is available for 2000 rupees in the cash market. Cash market is the place where if you buy the stock, you will get delivery. And when you sell the stock, you will have to give delivery of the shares. So let's say Reliance Industries is available in the cash market for 2000 rupees. And then there is something called as futures. Now, if the Reliance futures is available for 2005 rupees, all that the fund manager really has to do is buy the Reliance stock in the cash market at 2000 and sell it in the futures market at 2005. When they do this transaction, they lock this 5 rupees of benefit, which is going to be made by the fund irrespective of wherever the stock prices of Reliance go. So after having taken this trade of buy 2000 and sell 2005 rupees, even if let's say Reliance Industries goes down to 1000 rupees or 3000 rupees on the higher side, irrespective, your fund will still make this 5 rupees. So ideally, it's a very, very, very low risk profile kind of a product. And I will talk a little more about it in the future. But when you invest in arbitrage funds, you are typically investing in a particular product in which there is very little downside, and probably this fund will still end up making 6.5% for you. So that's the first category of hybrid funds that you want to know of. The second category of hybrid fund is something called as conservative hybrid. Now, like the name suggests, it's slightly conservative, which means that it will have roughly 10 to 25% allocation to equity and 75% to 90% allocation to fixed income. So when you invest money in this particular fund, be rest assured that the equity component of the fund will not increase more than 25%. It will be between 10 and 25. And most part of your investments will happen in fixed income, which will be 75% to 90% of the investments that you've done. So it's more conservative. The third, and probably in my opinion, the most interesting product that a lot of people don't know about in this particular space is something called as the equity savings fund. Now, if you see, 65% of the 100 rupees that you will invest is allowed to be invested in equity, and the remaining can be either in equity or in debt. But the minimum that needs to be in debt is 10%, like the table already tells you. What's the beauty of this particular product? Now, even when the category says or allows that you can have 65% in equity, not this entire money is invested in equity. Only 10 to 20% of this money is invested in equity. The remaining is invested actually in arbitrage. Now, why is this done? So let's say if you invest 100 rupees in the equity savings product, look at it this way. 10 to 20% of the money is going to get invested in equity, and the remaining will get invested either in arbitrage or in debt, which means this product is not very aggressive. It is very conservative because not more than 20% of your money is going to be in equity. The remaining 80% is arbitrage or debt. But the reason why you will see that the fund uses arbitrage is because it makes it more tax efficient. So look at it this way. Out of the 100 rupees that you've invested, if 20% is equity and the remaining 45% is arbitrage and the remaining 35% is debt, which means 65% of your money is still equity, because in taxation, arbitrage is considered as equity. So now you will have 65% of your fund which is invested in equity, but the risk of this product is extremely low because except for that 10-20% of pure equity, everything else is arbitrage or fixed income. So this is a fixed income kind of a product with 80% in arbitrage plus fixed income, which has very little risk, only 10 to 20% in equity. But still, when you invest in this product, you get equity taxation, which is the most important part of what you need to know about equity savings, because this is the prime reason why most people should actually look at investing in a product like the equity savings product. The fourth, if you see, is something called as the balance hybrid. Balance, like the name suggests, 40 to 60% of the money will be in equity and 40 to 60% of the money will be in fixed income. But here, when I say 40 to 60% of the money will be in equity, no arbitrage is allowed, which means when you invest in this particular product, they will actually invest 40 to 60% of your money in pure equity, not arbitrage. So this is actually riskier than most other products that we've spoken so far. So it is more riskier than the equity savings, and it is more riskier than the conservative hybrid as well as the arbitrage fund. One another interesting category is something called as the balance advantage fund or the dynamic asset allocation fund, in which if you see over here, the allocation to equity and fixed income is extremely dynamic. You've left it on the fund manager to decide how much and when do they want to increase allocation to equity or debt. So what they typically do is when they feel that the equity markets are expensive, they reduce their equity allocation, and when they feel that the markets are cheap, they increase their equity allocation. That's how they increase and decrease their equity and fixed income allocation within the fund to make sure that the outcome to you is the best. So unlike everything else that we've seen so far, where they've given a value of how much needs to stay in equity and how much needs to stay in debt, over here you've actually left it to the fund manager to decide how much do they think should be in equity or in debt. The most popular category, which has now become popular, is the multi-asset allocation fund. Why is it popular? Because you look at the requirement: minimum 10% in equity, minimum 10% in debt, and minimum 10% in alternates. So this is the only product which allows the fund manager to take position in precious metals also, like the gold and silver, which means after the fund manager has kept a minimum of 10% in equity, 10% in debt, and 10% in precious metals, they can use the remaining 70% wherever they want. So if the fund manager feels that there is going to be a rally in gold and silver, they can put the remaining 70% in gold and silver, allowed. If they think that they want to put the 70% in equity because equity looks cheaper, they can do that. And hence, because of what we've seen over the last 12-18 months in gold and silver in terms of rally, these funds have become extremely popular currently. And the last is something called as the aggressive hybrid. Now, like the name suggests, it's aggressive. 65 to 80% of the money will be invested in equity, and the remaining 20 to 35% will be invested in debt. Now, to summarize whatever we've done so far, hybrid is nothing but a combination of more than one assets. So when you invest in a hybrid, you are not investing in one asset class, but you are probably investing in 2-3 asset classes: equity, fixed income, precious metals, or any other alternates. And each of these hybrids are different from each other depending on how much money are you investing in which asset class. You all keep asking me how to actually invest in mutual funds, which fund is right, when to start, how much to invest, where to invest, and all of this for long-term investing. Now that's exactly why I have created a 7-hour long video on how to select the right equity mutual funds, where I'm going to share with you all some practical insights and framework that I personally use for investments. From goal-based investing to understanding the risk profiling, asset allocation, even macros that affect your risk and return, everything is covered step by step. So if you genuinely want to understand investing in a structured, practical way, you can enroll for this program through the link in the description or the pinned comment. Now that you've understood how are these funds different from each other, how are you going to be able to practically use this? Now, if you see, I have divided the 7 hybrid funds into risk profiles. So if you see, there are 3 funds out of the 7 that we've learned so far who are conservative in nature. So you will see that the arbitrage fund is conservative. You will see that the conservative hybrid is conservative, and you will see equity savings is conservative. So if there is somebody amongst you who is a conservative investor, then these are the 3 funds for you. Now, I would rather suggest that you can actually eliminate the conservative hybrid here. And if you are a conservative investor, focus only on 2 funds. The first is the arbitrage fund, and the second is the equity savings fund. Let me help you understand why do I say. So suppose, let's say, for example, if you are somebody who keeps money in a fixed deposit, or you are somebody who probably keeps money in the savings account, then you might want to look at this category, which is the arbitrage fund. Why? If you look in the last 1 year, arbitrage funds have generated roughly 6.85% returns. The 3-year average return of arbitrage fund is 7.53. 5-year is 6.3 and 7-year is 6.2. So you will roughly end up making, if I take the average of the last 5-7 years, roughly you will make 6.5% on the arbitrage fund. Now, like I explained to you earlier, arbitrage funds have very low risk because the fund manager will only take a trade if the fund manager sees that the price is 2000 and 2005, and hence there is an opportunity to make 5 rupees. They will buy one and sell one. So there is very less probability that you will end up losing money in an arbitrage fund. So you will not lose money in an arbitrage fund. You are making roughly 6.5% in an arbitrage fund. The best part about arbitrage fund is that it gives you an equity taxation. What is equity taxation? Equity taxation is that if you stayed invested for less than a year, it'll charge you only 20%. But if you stayed invested for more than a year, it'll charge you 12.5%. Let's say the arbitrage fund pays you 6.5%, which we've seen that it can pay on an average. And on that, if you end up paying 12.5% as tax, so what you get in hand is 87.5. What you are actually making post-tax is 5.69%. Now, suppose if your fixed deposit is paying you 7%, and you are in the 30% tax bracket, okay, which means you are going to get 70% back. What you are getting is only 4.9. So even if your fixed deposit pays you 7%, what you are getting in hand is 4.9. And in the arbitrage fund, when the arbitrage fund makes you an average of 6.5%, still post-tax you are making 5.7 in hand because it has the advantage of equity taxation. If I have to show you this slightly differently, let's say if I divide 5.7%, which is post-tax, by 70%, which means that your fixed deposit has to pay you 8.13% interest for you to be able to match the post-tax return of an arbitrage fund. So if your FD pays 8.13% and you pay 30% tax, you will get 5.69%. And in the arbitrage fund, if it makes 6.5%, you will get 5.69%. So 6.5% of arbitrage funds return is equivalent to 8.13% of your FD's return. So if you are getting anything less than 8.13% on your FD, your arbitrage fund is a much better place to stay invested in, provided you are going to stay invested for at least more than 6 months in this product. 6 months is the minimum time frame with which you have to come if you want to invest in this particular product. But this tax advantage of you getting taxed only at 12.5% only happens if you stay invested for more than 1 year. Which is why I think when you are a conservative investor, this is a great replacement to your savings account investment or your FD investment, because your FD is drawing anything less than 8.13%. Your arbitrage fund becomes a better place for you to stay invested post-tax. But like I said, minimum time frame that you have to come in with to invest in an arbitrage fund is 6 months, ideally more than a year. Now, if you are a conservative investor, like I was saying, you can ignore the conservative hybrid because equity savings is a much better product. Let me explain to you why. So if you look at the last 3-year return, your conservative hybrid has given 10, your equity savings have given 11, so 1% higher. You look at 5 years, your conservative hybrid is giving you 9%, your equity savings is giving you 10, again 1% higher. And that's exactly the same case over 7 years as well. So if you look at a comparison between conservative hybrid and equity savings, you will see equity savings makes you 1% return higher than your conservative hybrid. But is the product taking higher risk? The product is actually not taking higher risk. So now if you see, your equity savings fund has generated 1% higher over your conservative hybrid over 3-year, 5-year, 7-year, all period. But now the question, of course, that you should ask is, are you taking higher risk by investing in equity savings fund? And is it because of the risk that the fund is generating higher returns? Actually not. You look at the standard deviation of both of these funds, it is more or less the same. So your conservative hybrid has a standard deviation of 3.8 and your equity savings has a standard deviation of 4.3, which means that you're not really taking much higher risk by investing in the equity savings product, but you are making 1% higher returns on each time frame that we discussed, 3-year, 5-year, 7-year, and probably more if we look at it. There is one more advantage of taking equity savings fund. Equity savings fund actually gives you equity taxation, which means if you are going to stay invested for, let's say, less than 1 year, the tax to you is 20% on equity savings versus slab rate taxation on debt on conservative hybrid. And if you stay invested for more than 1 year, your equity savings is going to make you 12 or charge you 12.5% tax versus slab rate in your conservative. So not only that you are making 1% higher returns in equity savings, but you are paying much lower taxes. If you stay invested for more than 1 year, you will pay 30% tax or slab rate on conservative hybrid, but only 12.5%. So your post-tax return is far more superior in case of an equity savings versus conservative hybrid. So if you are a conservative investor and you've been investing in, let's say, savings account or smaller FDs like 1-year FD, arbitrage fund is a far better place to be. If you're a conservative investor and you've been investing for 1 or 2 years in a fixed deposit, equity savings is a far better product for you to invest. Now, like how we compared 3 funds when we spoke about conservative, we will now compare 2 funds if you are moderate risk profile investor. So if you're a moderate risk profile investor, there are 2 funds that you want to consider. First is the Balance Advantage Fund and the second is the Multi-Asset Allocation Fund. Now, who is this for? First, of course, if you are a moderate investor. But if you are an investor who's been investing in 2-3 years of fixed deposits or doing 2-3 years of bonds or NCDs, this is the perfect replacement for you. Or also, if you are somebody who've lately got excited that you want to do gold and silver, these are the funds that you want to focus on, and I'll tell you why. Now, if you look at both of these funds, how are they different from each other? The only difference is actually, for all practical purposes, is that in a balance advantage fund, you are not allowed to do, or you typically don't do, probably a precious metal like gold and silver and REITs and invest, which you actually do in a multi-asset fund. So in a multi-asset fund, the fund manager can take positions in gold and silver, but in a balance advantage fund, the fund manager cannot take position in gold and silver. But you look at the return dynamics, okay? So in 3 years, the balance advantage fund has done roughly 13.4 and the multi-asset has done 18.6. In 5 years, the balance advantage has done 12.2, the multi-asset has done 17. And 7 years, the balance advantage has done 11.9, which is 12%, and the multi-asset has done close to 16. Now, if you compare both of them, you will see that the multi-asset has significantly outperformed the balance advantage fund over 3-year, 5-year, and 7-year by at least a 5% margin, which means that the multi-asset fund has done 5% higher than the balance advantage fund has done. But have you taken more risk for that? Absolutely not. The standard deviation or the risk of a balance advantage fund is 7.6 and that of a multi-asset fund is 7.22. In fact, your multi-asset fund has lower risk than your balance advantage fund, and with lower risk, it has been able to generate close to 5% CAGR more over 3-year, 5-year, and 7-year versus the balance advantage fund. Of course, the catch here is that the last 1 year returns on gold and silver has been so significant that the multi-asset fund has actually outperformed, or it looks like outperforming the balance advantage fund significantly. Had gold and silver not done so well, your returns would have been very similar. So if I am given a choice to select between a balance advantage fund and a multi-asset fund, the data shows that the risk is almost the same, but the multi-asset fund has done 4-5% CAGR more than the balance advantage fund. So you would typically want to opt for a multi-asset fund in general, because the multi-asset fund also allows the fund manager to take position in gold and silver if at all need be. The only disadvantage of multi-asset fund here, in my opinion, is that if your fund manager is active and is going to take positions in gold and silver, then the taxation to you is hybrid, which means that you will have to stay a minimum of 2 years in the multi-asset fund for you to get 12.5% as taxation, which is the equity taxation, which the BAF generally gets after 1 year. The only disadvantage of probably a multi-asset fund is that if your fund manager is pretty active and has taken large positions in gold and silver, okay, in that case, the taxation that you will end up paying is that of hybrid. So if I have to choose between a multi-asset and a balance advantage, first, I will need at least a 3 years of investment horizon. I will only come in if I am a moderate risk taker. This is a great replacement to your 3-year FD, to your NCDs, to your bond kind of investments. And if I come in with a 3-year investment horizon, I have seen that multi-asset allocation fund gives the fund manager the ability to invest in gold and silver, and it has significantly outperformed over 3-year, 5-year, 7-year by at least 4-5% CAGR. So if I have to choose between either of them, I would rather go for a multi-asset fund than I go for a balance advantage fund. Now, if you are an aggressive investor, let's compare 2 other products. First is the aggressive hybrid, and I've added the large cap equity fund here to show you comparison. So if you are an aggressive investor, I would still believe that the hybrid fund is a better place for you to stay invested than the large cap fund. I'll tell you why. If you look at the last 3 years return, your aggressive hybrid has generated 16.2, your large cap has generated 16.3, very similar. You look at 5 years, the returns are very similar, 15.6, 15.7. You look at 7 years, the returns are very similar, 14.5 and 15.1. So your returns are very similar, where your large cap probably is doing 0.1 to 0.45 better than your aggressive hybrid. But I'll tell you where the entire difference is. The entire difference is in the risk. So when you invest in the aggressive hybrid, you are actually taking 10 standard deviation risk. But when you invest in large cap, you are almost taking 13 standard deviation risk. And when you invest in an aggressive hybrid, you are actually taking 3 units lower at 10. So by reducing your risk, you are probably able to generate almost the same returns that a large cap fund generates. Then why not stay invested in a aggressive hybrid? Aggressive hybrid will have close to 65 to 80% in equity, and hence there is no differentiation in terms of taxation that you might have for aggressive hybrid as well as large cap. In both of these cases, if you stay invested for more than a year, your tax is 12.5%. So first, if you are a conservative investor and you are actually looking at a savings account or less than 1 year of FD replacement, arbitrage fund is the place to be. If you're a conservative investor and you are actually looking for an FD replacement that you do for 1 to 2 years, equity savings is the place for you to be. If you're a moderate investor and you're looking at a solution to your 3-year FD or a NCD or bond, then multi-asset allocation fund is a great place to be. This is a great place to be even if you're looking at a gold or a silver allocation to your portfolio. And if you are an aggressive investor and you're looking at a replacement to your large cap equity investment, then aggressive hybrid is a great place to be. I hope in this video you would have completely understood everything that you would want to know for you to be able to make a decision of which of the hybrid categories out of the 7 is meant for me and why, along with all the nuances that you would have otherwise looked at in general to be able to figure out which of these hybrid categories is actually for you. If you have any questions, please comment. I'll be extremely happy to take these questions up and solve all the doubts that you might have. Stay tuned because I'm going to come up with a lot of more videos in and around mutual funds and personal finance. And if at all you've liked this, do subscribe and click the bell icon so that you will get an intimation every time I will put up a new video. Thank you so much.